evening, everyone, and welcome to the Ford Presidential Library. My name is Elaine Didier, and as many of you know, I serve as director of the library here in Ann Arbor and also the museum over in Grand Rapids. It's a great pleasure to welcome you to our last event of the spring 2009 season here at the library. We've had a very strong season of programs this year with distinguished journalists, authors, and special events in conjunction with Lincoln's 200th birthday and also Mrs. Ford's recent 91st birthday. Before introducing our speaker, I'd like to introduce the new executive director of the Gerald Ford Foundation, Joe Calvaruso. Joe, where are you? You're here somewhere? There he is. Okay, great. Joe joined the foundation in December of 2008 after 29 years in the banking industry, and some would say that was perfect timing on his part. Joe is off to a great start, and we're really, really pleased to have him joining the Ford Library and Museum and Foundation team. He's using his expertise to help grow the assets of the foundation so it can provide even more support to the library and museum than it already does. And again, for many of you know, the foundation is the sole source of our support for programs such as this. So it's rather important in our lifeline. So we're very pleased to have Joe with us tonight. As we get ready to listen to our distinguished speaker this evening regarding the economy, I would like to point out the fact that the lobby has a very special exhibit during this period focusing on the economic challenges of 1974 and 75 during the Ford presidency. Economic crises on an international scale are not new, and President Ford inherited a very tough one in 1974. The economy in crisis draws on rarely seen archival materials from our collections and artifacts to show how he attacked what we're calling a witch's brew of inflation, recession, budget deficits, along with worries about oil supply. And I think that our speaker tonight will have one or two comments about those things. During this difficult period in the Ford administration and for our country, our speaker this evening, Mr. William Seidman, served as President Ford's Assistant for Economic Affairs from 1974 to 1977, advising him on economic matters. Mr. Seidman brings a most distinguished and impressive record to grace our podium, and it's a great honor for us to have him here at the Ford Library. Like President Ford, Mr. Seidman's story starts in Grand Rapids. He received his undergraduate education at Dartmouth College, and then, like President Ford, he served in the Navy in World War II, stationed on a destroyer in the Pacific. And tonight over dinner, I confirmed that he survived the same typhoon that President Ford survived when only he was serving on the Monterey, an aircraft carrier. After the war, Mr. Seidman returned to earn a law degree from Harvard University, and then he got the best degree of all, an MBA from the University of Michigan's Business School. Along the way, he helped his father build a nationwide accounting firm now known as BDO Seidman in Grand Rapids. He began his government service as an economic advisor to Ford, as I mentioned, and later worked in similar capacities for President Ronald Reagan from 1982 to 84. In 1985, he became the chairman of what we know as the FDIC, the Federal Deposit Insurance Corporation, and served there until 1991. He worked extensively through the problems of the savings and loan crisis that you might recall. He was also the chairman of the newly created Resolution Trust Corporation, which was created specifically to address issues from the savings and loan crisis, and led that from 1989 until his retirement from active government roles in 1991. In addition to these government service positions, Mr. Seidman has led a rather interesting life. He is known as the father of Grand Valley State University. He served as chair of the first board there for 14 years, and now the business school at Grand Valley is named for his father, but also for him for his service to starting that institution back in 1960. He also started something called the Washington Campus, which is a program that enables business students to take trips to Washington to understand the issues there. And he's also done a stint as the dean of the business school at Arizona State University in the 80s. So this is a man tonight who has written a memoir, helped foreign governments fix their financial problems, and he now is the publisher of a magazine for bank directors called, guess what, Bank Director. He has also made mobiles with Alexander Calder and appeared in the Academy Award-winning movie Ordinary People. He is a man of many, many talents. But in addition, I want to share with you something special. He's known for his sense of humor, and he loves telling people why he had an Irish wolfhound who's no longer with us, but his Irish wolfhound was named Proxmire. Some of you might know the story. At the time of his confirmation as FDIC chairman, the chair of the Senate Banking Committee was none other than Senator William Proxmire, a Wisconsin Democrat, and the only senator who voted against his nomination. You can appreciate that he enjoyed instructing his dog thusly to say, "Heel, Proxmire," "Sit, Proxmire," and "Stay, Proxmire." Today we know Mr. Seidman in yet another iteration of his career, and that is as a commentator on economic issues on CNBC. In fact, he will be doing a live broadcast from the Michigan Ross School of Business tomorrow morning, commenting on all of the issues of our day. He's on a number of corporate boards, including the board of the Gerald R. Ford Foundation, and he's in great demand, so we are very lucky people indeed to have him here tonight. William Seidman.
Thank you, Elaine. It's a very great pleasure to be here and honor Gerald Ford, my old boss, by having a chance to say a few things to you about him, and then we'll go on to less pleasant subjects. Actually, I'm going to try to do three things. I'm going to talk a little bit about serving Gerald Ford and the economic problems in his administration. And then I'm going to take a look at where we are now and how we got to where we are now. And then finally, some thoughts about where we might go to get out of the problems that we're in. Now, a good many of you may wonder why I haven't retired by now. Obviously, I am a senior citizen. And I planned to retire. And I had in mind a 70-foot yawl with a rather attractive 18-year-old crew. It turned out that I had the numbers reversed. Yeah, it was an 18-foot dinghy with a 70-year-old crew. So now you know why I'm here. But you know, you don't want to question the judgment of the older folks. I had a good friend about my age, and he was walking down the path one day, and he saw a frog, and the frog said to him, "If you pick me up and kiss me, I'll turn into a beautiful young princess." So he picked her and put the frog in his pocket. The frog said, "Do you hear me? If you kiss me, I'll turn into a beautiful young princess." And my friend said, "At my age, I'd rather have a talking frog." So I come to you with those warnings, but let me say that one of the great privileges of my life was, of course, to serve Gerald Ford. I had an office in the West Wing during his term as president. I was with him as vice president. And one of the things that has always bothered me is that everyone celebrates his ability to, quote, heal the nation after Watergate. But the fact of the matter was that he had one of the most active and serious economic problems during his administration that we had had since the Great Depression, and something that is in the same level as we have today. I won't go all through that, but I want to give you a couple of instances why I so admired him. He knew government, he knew how to run the machinery, and he knew how to make decisions. And as I've watched presidents since then, if there's one thing that we have seen, it is that some presidents really have great difficulty arriving at decisions that are well thought out and good for the Republic. Ford, as you know, had been a congressman for 25 years, and he really understood the fact that when you were making a decision that affected 300 million people and a $12 trillion economy, it wasn't like running Goldman Sachs. That's something that our last Secretary of the Treasury never really found out, which is an entirely different kind of a ballgame. And let me illustrate. When Ford had major economic problems, as he did, he wanted to hear every point of view. We had meetings 3 times a week in which people argued various types of action that ought to be taken. And after one meeting, he told me, "Don't invite that guy back again." He didn't say anything. I want people who advocate. And as I've watched presidencies since then, if there is one thing that every president ought to have, it's a way to make decisions after full information. And one of the things you can say if you look at the presidency of George Bush II was that he had a very narrow group that advised him. And as a result of that, he made some very narrow decisions. And his people were the same way. So the one thing that you could say about Gerald Ford was he loved to have people disagree with him. I defy you to find anybody else in politics who really enjoys that. He just happened to have learned, being a congressman 25 years, that you have to have an information base, and that it's very difficult in a huge, diverse country. And let me illustrate with when this recession came along. The question was, what should the president do about the recession? Now, his 2 top economic advisors were Alan Greenspan and Bill Simon. And they were both, I don't want to call them right wing, but they were way over on the right, conservative Republicans who were devastated by the fact that the government was running, a $60 billion deficit, not enough today to even bother to look at the numbers. So they both took a strong view that Ford could not cut taxes, he could not start new programs, that if he just would tell people to take life as it came, there would be an upswing based on the natural resiliency of the economy in the United States. And he finally said to me, "Well, I'm getting all this information, it's the same." And I said, "Well, I'd like to introduce you to a bunch of other people who don't agree with our friends." So we had in some of the leading economists in the country. They made their presentations. Simon and Greenspan were there and violently objected. But Ford was really one of the first Republicans who cut taxes as a way to try to increase economic activity. And that program, in his case, proved to be a remarkable success. And I just want to tell you that at the end of his 2.5 years, the economy was headed towards a balanced budget. Unemployment had gone down from 9% to under 6%. Inflation had gone from 12 to under 6%. And the economy, every vital sign showed it was going in the right direction. And well, now I will show you my partisanship. Within 2 years after his successor, President Carter, got in office, all of those lines turned around and were going the other way. Inflation was going up, unemployment was going up. So Gerald Ford was far more than a healing president. He was really a president who could handle the situation because he knew government. And I'll give you just one more illustration and then we'll move ahead. But as you know, he vetoed over 50 bills, spending bills, more than any president had ever done in the past. And every time he vetoed a bill, of course, some group that thought they were getting a lot of money ended up not getting so much money. And I remember talking to him about it, and I said, aren't you concerned that you're alienating everybody in the United States? I mean, you have vetoed a bill for almost anybody who gets anything from the government. He said, no, that's not really the way it works. Our government works on the basis of all politics is local for the Congress, for the Senate. But there's one person that has to protect all the citizens, and that's the President of the United States. So when I veto a bill, whoever sponsored that bill probably knows he got too much money. Probably knows that really if he could represent the Republic as a whole instead of his constituency, he wouldn't have gotten so much money. So I'm taking the heat for him so that he can vote after the veto on a lower amount so we can move towards a balanced budget. And the fact of the matter was that those 50 vetoes, as far as anybody can tell, were not an important factor in his losing the election. Well, I could tell you a lot more things about President Ford. I'd like to do that, but we have limited time, so if you want to talk about it afterwards, I'll be happy to talk a little more about some of the other things he did, like New York City and other things. Remember the headline, to New York, drop dead? That was a bad rap. Anyway, let me go on. And I'd like to start by saying, how did we get in the financial and economic mess that we're in today? And people may argue a little bit about what I'm going to say, but there's no one that won't argue that we're on a major financial distress. And if we're not in a recession, we're in a depression. And in my long history, the only time I've ever seen an economy like this was in the Great Depression. But the optimistic note is that I'm here tonight, so you can live through it, you know. Well, I'd like to pinpoint for you people with names and dates of decisions that were taken that put us where we are today. Because I think it's quite easy to see decisions that were made by people who may have made them in the most altruistic and way and believed that they were doing right. But when you put them all together, we ended up in the worst financial crisis we've had since the Great Depression. And I think when you try to classify them, you will see they are in two classes. One is lifting the standards or reducing the standards by which lenders made loans. Lenders have a lot of rules about, and you all probably have borrowed, and if you don't meet the standards, you don't get the loans. That was eroded and became almost to the point where, here, we'll give you the money, we don't care about the standards. The second thing was that regulation of the financial system, which was supposed to provide a way for the system to work within rules that would protect free enterprise and the system that we had were badly or totally ignored. So we had the combination of bad regulation and erosion of standards, and together they put us where we are today. Let me say one word about the regulation. I was part of the deregulatory movement, which came out of the Ford presidency. And we clearly had a lot of regulation that hurt the operation of the free enterprise system. But regulation, if it's done right, is supposed to enhance the competition in a free enterprise system. It's not supposed to be there in order to tell people they can't do anything because it's not socially acceptable. It's to be there so that we will have a system that works in the private sector. And I started out not long ago to write a book, and it was entitled "The Free Market Needs an H of a Lot of Government in Order to Succeed." And I often compare it to the difference between a prize fight and a barroom brawl. If you have a prize fight, you're trying to promote a fight, but you have rules. You have to stay in the ring. You can't pick up the stool. You have to listen to the referee, and you try to enhance the competition. In a barroom brawl, there are no rules, and of course, in the end, it busts up everything around it, and usually the least socially productive person wins. So now let's get back to how that all applies to what happened to us. First, let me talk about the the standards problem. As you know, this all developed out of subprime home loans. Home loans to people who were not creditworthy under the old standards. And that was pretty much made acceptable because one of the biggest banks, Hong Kong Shanghai Bank, bought one of the commercial secondary lenders who made, if you will, subprime loans. But that was never considered to be a major interest of the major financial because those borrowers did not meet the standards. Once Hong Kong Shanghai bought that and started to promote that, subprime loans became acceptable. Well, the first thing that happened was that an avalanche of them came to Fannie and Freddie. And as you know, they securitize more than half of all the home loans that are made in the United States. So without them, no one can succeed in that business. They are by far the most important factor in home lending. Well, these subprime loans came up to them. Their staff recommended against their securitizing them, that is, putting them together and giving them a government guarantee. And the staff said they don't have appropriate down payments, the record of the borrower is not sufficiently strong, and therefore we do not believe that we should be in that business. And the head of Fannie then was a fellow named Mudd, little Dixonian type thing. Anyway, Mr. Mudd, who was not a financial guy, his father was a TV broadcaster for public broadcasting, and he'd been over on the PR side, and he was the rather new chairman, and he said, well, this is going to put more people in homes. This is exactly what we're in business to do. So he convinced his board to override the staff, and Fannie and Freddie began to put their name on these subprime loans. That was kind of like number one in the change of the standards in the United States. Next, the rating agencies, who, as you know, rate these loans generally in packages called securitizations. And the rating agencies face the same problem. Their rules said we cannot rate anything in which we do not have an experience record to provide us with a basis for rating. And they had never rated subprime loans. There hadn't really been a big market in subprime housing. So they faced the question, shall we rate these and change our rules and rate them even though we do not have a history upon which to do so? And they testified before the Congress, and this time the leader was Mr. Rader, so you can see how the names worked out. And Mr. Rader and his group decided that despite their historical tradition, they would go ahead and rate these loans because that's where the business was. And that's what they said. So we had the agency that was the biggest guarantor of loans and the rating agencies both changing their standards at a time when obviously the creditworthiness was going down. Now both of these things obviously enhanced the availability for money, and the availability for money meant that housing prices were going to go up. And so that was part of the whole deal, was that people said, well, we don't have to worry about raising the standards because the prices are going up. Now, we had a housing bubble in this country. I'm sure you all are aware of that. You may not be aware of the fact that out of the 20 top nations, we were actually 14th down the line. In other words, there were 13 countries who had faster rising prices than we had. So while you can blame certain things on Fannie and Freddie and so forth, you can't blame it all on them. What you can blame is that what we were doing, the other guys did, only they did it better than we did. So the net result was enhanced housing bubble all over the world. Now let's look at the other side for a minute, regulation. Most of these loans that were being put together from subprime borrowers took some selling. I mean, they were not the people who were used to getting credit. So the mortgage brokers went out to find those people and sold them these loans, and often said, well, I know you can't pay what this loan requires, but by the time you have to pay, the housing price will go up so much that you'll be okay. And they put that together. Now you think, well, some regulator should have said, you can't do that, you know, that's illegal. Well, why didn't that happen? It didn't happen because the Congress had given the Federal Reserve the power to regulate mortgage brokers. But the Federal Reserve, under Alan Greenspan, who I've known for years and was a great central banker, but a lousy regulator. Anyway, he said, I'm not going to regulate these mortgage brokers because they're operating in a sophisticated market, and the market will arrive at the fair prices, so they don't need any regulation. And he went before the Congress, and I can remember the chairman of the House Banking Committee saying, we gave you the power to do this, why aren't you doing it? And he gave the answer, because they don't need it. So that was one of the places where regulation fell down. Another place that regulation fell down was in investment banking. As you know, the major disasters we've had have been very much tied up with the big investment banks, Bear Stearns, Lehman, Merrill Lynch, and so forth. Now, how did they get to put us further into this kind of perfect storm, if you will, of things coming together? Well, the five biggest of that group, which are Goldman Sachs, Morgan Stanley, and the other ones I've mentioned, went before the SEC and said, we want to change the capital standards in our industry to what, if you're in banking, is called Basel II, but really means we want to set the capital standards based on the experience we've had in the last 10 years. So since we've had a great 10 years, we aren't going to need so much capital, because you can see from that we are protected with much less capital. At the time they did that, the SEC had a flat rule that you couldn't have more than 15-to-1 leverage. That is, you couldn't borrow more than $15 for every $1 you had in capital. When they went to the new standards, they took that off. Within 2 years, the average in the industry was somewhere between $30 and $40 borrowed for each dollar of capital, obviously increasing the risk by a huge amount. And Bear Stearns became, and Lehman, but mainly began to buy these securitizations of subprime loans because they were making a lot of money on them, and the more they owned, the more leverage they had, the more money they made, the bigger their bonus was, etc. And in order to grow that fast, they had to get the money. And so the way they raised the money was by putting these mortgages up in overnight financing. So of their total financing, somewhere between $15 and $20 billion was overnight financing. In other words, if somebody said no in the evening, you were out of business by the morning. And that's exactly what happened in the way Bear Stearns finally went down. So we had both deregulatory and erosion of standards, and together they gave us the problems that we have today. Now, when that starts to happen, credit markets show what credit really is. You know, credit comes from the word credo, and credo means trust. And if there ain't no credo, there ain't no credit, because nobody trusts anybody. And they may not trust anybody not because they think they're crooked, but they simply don't know, because the marketplace has become so eroded by these standards and everything that it's very hard to know where anybody is. So we finally hit the day when the banks suddenly said, after these investment banks went busted, we're not going to lend any more money till we find out where we are. And we know we got big losses because we loaned on these things, and now they're not going to be worth as much. And so they just quit lending. Absolutely and utterly quit lending. And there was a good old-fashioned panic. I mean, panic is when reason leaves and emotions take over. And all of our hard-nosed financial guys became panic-stricken about what was going on in the system. And particularly the banks, because the banks are regulated and they have to have a certain amount of capital in order to support a certain amount of loans. And if they have losses on those loans, it reduces their capital. And therefore, they've either got to get more capital or shrink how big they are. Thank you. Is it that bad? I don't know. You're putting out the fire. Anyway, so given that people would not make loans, they began to look at what they had in their inventory that they'd already made loans on, and they said, whoa, we're going to have a bunch of losses. And if in banking your capital goes down, the regulators put you out of business. We have what is called prompt corrective action, which says that if your capital goes down to, let's say, 1%, then the regulator by law has to come in and close you down. So that's kind of the situation in which we found ourselves, and the same thing was happening all over the world. In fact, in the UK, they adopted this Basel II, this kind of look back for 10 years, for all their banks. As a result of all their banks had about half as much capital as we had in the United States, and they were all broke within the first 2 months. And they've all, most all of them except one, been in effect taken over by the government. So it was not a pretty scene. This was happening right at the end of the Bush administration. And the Bush administration had Secretary Paulson, former head of Goldman Sachs, as the quarterback to get us out of the problem we were in. And here's where things get hard to believe, at least for me. I mean, Secretary Paulson and his group, without consulting a wide group, and certainly not consulting any of the people who had already been through it, of which I was the chairman back in the S&L days, decided that what they had to do was go into the banks and buy out all these bad assets, and therefore the bank wouldn't go busted because the bad assets would be off their balance sheet and they would be replaced by cash. So they announced that. They told the Congress that if you don't pass this, the world is coming to an end, and I don't want to be here when it does, so I'm leaving. So, and the net result was that the Congress passed a $700 billion rescue package designed to buy these toxic assets, as they call them. Well, what happened? I wrote a piece for the Wall Street Journal, and I said, I don't think these people really understand that they're not going to be able to do what they say, because the banks are not going to sell these assets at market value, because if they do, it'll reduce their capital and they'll be taken over. And the buyers, if they pay a much higher price, are going to take a tremendous loss. And I said, I was in Japan for 6 years when they had exactly the same problem. And in fact, I was hired by the Japanese government to try to get somebody selling and somebody buying. And despite having one of the most capable financial people in the world, I got nowhere. I mean, it was not possible to bridge that gap. So there are a lot of people that said, you know, you're not going to get anywhere this way. So Mr. Paulson went to a meeting of the group of 20. We started on Friday and got over on Sunday. And by Monday, he came back and said, we have a whole new plan. And it's going to be like the Europeans. We're going to put money in the banks so that they will be able to loan because they've got new money. And he called in the 8 or 9 biggest banks and said, we're putting money into all of you in exchange for a preferred stock. And we don't care whether you need it or not, or whether you want it or not. It's your patriotic duty to take the money. Now, the only other place I've ever seen anything like that is Japan, where face is everything. And in their thing, they said, you know, every bank will. So we suddenly had a brand new program called the TARP program, which was not the reason the Congress appropriated the money, and was designed to make the banks, the big banks, have more money so they could make more loans. But of course, the big banks were not eager to make more loans because even with this money, it was not real capital, so it didn't really keep them from going broke. And besides which, by this time, we're in a recession where good loans are much harder to find. In any event, they studied what they did, and they decided, well, you can't do this just for the 8 biggest banks. You got to do it for all the banks in the country, 5,000 banks. So they decided, okay, but we're only going to put money in good banks who will make loans. Well, pretty soon they decided those aren't the banks that need the money. It's the ones that are in trouble that need the money. So they reversed 180 and went the other way. Now, you know, if you came from Mars and looked at this, you would have thought it was a situation comedy or something. It really is hard to believe. That's where we are now. Let me talk about the second part of that. As I said, there was panic. The system was frozen up. So the Fed did things that they have never done before in history, and that is they began to loan money to support the system wherever it was needed. For commercial paper, between banks, between they and the FDIC, they guaranteed everything practically in the financial system with a federally guaranteed funding from the Fed or the FDIC. And that's where we are today, incidentally. Most every financial transaction of size is guaranteed by one or the other. And let me just point out, you know, Goldman Sachs is saying, we want to get out of the government, we got to pay back our TARP money and everything. $14 billion, but they got $20 billion borrowed from the FDIC with an FDIC guarantee. So they don't want to get out that bad because the law that covers compensation, they say covers the TARP but doesn't cover the FDIC guarantees. I mean, this is really hard to believe. Well, that's about where we are today. We're going to now have a new program which essentially is going to try to get these toxic assets out of the banks by subsidizing the buyers so they can pay a higher price and the bank will be willing to sell. Now, who are the buyers? All these guys that put us where we are today. And what we're doing is saying, if you will come in and form a partnership with us, we will give you a loan of 6 times what you put in. And if the enterprise goes bad, you have no liability. If it goes well, you got half the profits. And with that, you ought to be able to bid a higher price, and therefore you can take these assets out of the system. And the FDIC has been commissioned to organize these auctions, get the buyers, and so forth. Well, to get the assets out of the banks have to agree that whatever they auction at, they're going to get a price that doesn't break them. So the first thing the banks say is, we want a reserve price. We can't sell below this. So then the next thing is that the buyers have to decide whether the subsidy of all this leverage will help them pay a high enough price to get the buyer and the seller together. Now, it is really strange, but leverage, as I've said, was one of the real things that got us into this mess. Now we are creating leverage, government guaranteed, in order that the private sector participants, mainly hedge funds and so forth, will be able to buy some of these toxic assets. And even then, we don't know if it's going to work or not. today. They haven't held an auction yet. That's where we are. Now, the Fed has similar kinds of things to buy securitizations, which are in the frozen market because nobody knows what they're worth. And they may have 10,000 of these subprime mortgages in them, and who knows what they're worth. So the Fed has set up a system where they are going to lend the money to the private sector to buy those mortgages. And the Fed has set up another system that the banks can borrow really anything they want to support their operations. I mean, if you're a banker today and you don't have any bad debts, you are guaranteed to make a ton of money because you can borrow money for practically nothing from the Fed and loan it to people at market rates. So where do we go from here? That's a good question. The New York Times called me yesterday and they said, we'd like you to do an op-ed piece on where we are and where we're going. And I said, well, what would you like to hear? And in any event, they said, well, we want to know, what do you think? What are we going to do? And I said, well, we've got all, in effect, what we have done is said, these markets that were frozen because of panic, we will open up by making them government guaranteed. So you don't have to panic because you know that whatever you're buying will have a government guarantee on it. And that is, in fact, the way the market is operating today, not on private sector credit, but on government guarantees. So that raises a couple of questions. One, what will happen when the government takes off all these guarantees? Will we have reestablished credit and trust and so forth that the system will work? Or if it doesn't, we'll be right back where we started from. Nobody knows, the answer to that question. What happens when you take the government guarantees off? In addition, in order to supply all this credit, the government has, and you can get a lot of different numbers, but created somewhere between $9 and $13 trillion worth of guarantees and liabilities, which obviously, if they have to make good on, will either break the government or require huge taxes to support. Now, none of this has anything to do with the stimulus package that you've heard about. That's over here. That's the president's kitty to make sure that anybody who was in his camp at the appropriate time sees some money. And it's going to do some other things too. I don't want to be too. But essentially, it is in addition to all the rest that we just talked about. So the bottom line now is, okay, we got a system propped up by the federal government. We got $700 billion of stimulus spending, which I know in a number of cases, the people in the community are getting the money and they don't even know what they're going to do with it. This opens the way for a huge potential fraud. And if you see the report of the supervisor, the internal control guy, if you will, for the banking side, he says this system is made to allow people to commit fraud. And it will take a huge effort to keep people from stealing huge amounts of money. Now, when I ran the RTC, we had the same problem. We had all these assets we had to sell and all. But we did not do what they have done. We did not give a bank money unless we took it over. That's called closed bank assistance. They gave open bank assistance. They gave them money, but they took some stock back out. So the net result of all of that is that because they gave open bank assistance, the government is now a partner with something like 500 banks, including all the big banks in the country. Now, there are very few private enterprise people that want to have the government as a partner. Because as much as you may love Barney Franks, is not liable to have you doing what you really want to do to make money. And all the things that the private sector do, you got to clear with your partner. And they've just made this worse by saying we're going to convert the preferred stock to common stock, and that means you're there because you can't buy that out. You can't take that out. So I like to end on an optimistic note. And there are some things that you could say are improving. One of the things is that human nature does not allow you to be in a panic forever. Panic, finally, you don't have the energy to panic anymore, and you start thinking about what you might do to get out. And I think we're moving at that stage. The banks have begun to loan more money because they're less panicked about whether they're going to get taken over. They're not really feeling good about it, but they see that the government wants to keep them in business. Other businesses, some of which are not directly dependent on the financial system because they don't borrow money, have started to show some improvement because they're not going down as fast as they were. They're still going down, but they're not going down as fast as they were. Well, that's good. You got to be thankful for that, you know. And we all know there is a bottom to this. There is a bottom, and at some point we'll start doing better. But what we don't really know, and I certainly don't know, is whether all these things the government has done, buying in this, putting money in that, and so forth, is helping or hurting. Because we really don't have any experience upon which we can make that judgment. We know in the Great Depression, FDR and the Democrats did a lot of the same kind of thing. And when they withdrew the money in 1936, the economy went right back down again. Now, we don't know when that's going to happen here. We don't know when they're going to withdraw the money. We don't know how much the Congress is going to get in to trying to run the banks through the Treasury ownership. So this is an exciting time to be watching finance. Now, I know you enjoy short speeches, and I'm going to give you a short speech. So, I learned about short speeches when I was at the FDIC. I used to have a speechwriter. I was much better then. And the speechwriter would come to me, and I'd tell her what to do. And I said, I want a 15-minute speech because I'm talking to bankers, and their attention span is short. So give me a 15-minute speech. So she gave me the speech, and it went a full half hour. And everybody was bored, and I went back to her and said, I told you a 15-minute speech. How come you gave me a speech that lasted for 30 minutes? She said, Mr. Chairman, I gave you 2 copies. So, all right. So this is going to be a short speech. I think we have a lot of wisdom in this country. There's no doubt we're going to recover from this. There's no doubt in my mind that the government is trying to help us. Whether in fact they are or not is the question that I've raised. But we're going to need a lot of ingenuity and wisdom to get us where we have to go. And I would say for Obama that as far as I can tell, at least he has a broad group which he's listening to. And I only hope that he's as good as the skipper of the destroyer I was on. He was a real old Navy man, and we were sitting in the wardroom one day after a major suicide plane attack, and the chief signalman came in and said, "Captain, I have a message for you." The captain said, "Read it." The chief said, "Well, it's for you, sir." And he said, "Read it." Well, from Naval Commander to Captain Hotbecker, "Your seamanship today, the worst I've seen in 20 years at sea." So all of us young officers looked at him and he said, "Very well, Chief, take that below and have it decoded." So let us hope that we got an ingenious leadership of that nature. Thank you very much. I guess I am supposed to try to answer your questions. If I haven't confused you so much, go right ahead. Go ahead. No.
There's a lot of talk about inflation in the next decade or whatever. There's different conditions why. Oh, I'm sorry.
Yeah, the question is what they're doing now creating so much money to support all these things that we're going to see a big inflation as a result of printing a lot of money to make good on all these government guarantees. If you ask the Fed that, they will say it will not happen because we can pull that money back very fast. Everything we put out there are loans, and they say we can take it back, so we'll take the excess liquidity out of the system very rapidly. And so we won't have inflation. And besides, today we have deflation. So we're a long way from getting to that. The answer to that is the Fed is either right or wrong. And I don't know the answer to that. I know a lot of good people that think we will end up with inflation, but I happen to know the chairman of the Fed and have talked to him about it, and his answer is pretty reasonable. Now, we're going to have huge deficits, and that we're going to have to do something with, and we're either going to end up raising your taxes or printing money or borrowing more money, which we have to pay back. So you will be voting on whether you want somebody to tax you more or inflate the currency. And that's a bum choice. But that's likely to be where the decision is made. And one of the things that bothers me about what we've done now is that we've sort of taken all our chips and put them on the table and rolled the dice. If what we've done now doesn't work, we're busted. We don't have a second chance. So that's a kind of a bad answer for you, but at least it shows I'm confused like everybody else. Okay?
I was wondering why you had any comments regarding why we're not monitoring the stimulus package. We don't hear anything about the Obama saying so many jobs have started now, blah, blah, blah. And quickly, second, do you have any comments about the CFO who just committed suicide?
Yeah, I just heard about the CFO that committed suicide. He must have heard one of my speeches or something like that. I don't know anything about that. I don't really know anything. But Obama has been pointing out that certain things are getting better, or at least not getting bad so fast. And you have to remember, he's just in his first 100 days, and he got handed the worst economic problems since the Great Depression. So, while I happen to be a good Republican, you know, I would cut him a little slack here, because he's got a huge problem to face. I think at least he's trying to do something, what his people say are right, but he had to pick up this massive mess that the banking system had, and unfortunately, I don't think he's come to the right answer in fixing it, but at least he's trying to do something. So all I can say is, if I were there, I wouldn't do the same thing, but then I'm not there. Yes, sir.
Leads into my question. If Paulson had called you last summer and said, we've never done this before, you have, and you have unique experience in that respect, what would your advice have been? And then carrying over to the...
Well, my advice would be, get out of the business of giving banks money. If a bank can't survive without government money, take it over, fire the management, get a new board, take the bad assets out, and sell it back into the system. Well, that's what we did. You know what? The RTC did that literally hundreds of times. Now, they say, oh, yeah, but they weren't as big as Citibank. The size doesn't make any difference. They say, but you can't close Citibank. Well, we didn't close banks. We just took over the ownership. They kept operating. And then we said, now we got to get a better management, and we got to get the bad assets out. And we could get them because we were on both sides of the deal. That's what I would have told them. When I came to the FDIC, they were doing open bank assistance. And I said, we'll never get out of this if we tell people that if they're in trouble, we'll give them more money. So flat out, we're not going to give any open bank assistance. And the result of that was this one is gin. As a result of that, I had to have an armed guard to go into Texas because there were so many banks that we closed in Texas. We closed over 1,000 banks. So you got to have the attitude that you're going to clean up the mess, and you can't clean it up by continuing to give money to the people who put you into the mess.
But if the assets didn't cover the liabilities, once you sold the assets, you've got huge liabilities.
The government has to make up the difference. That's right.
That's trillions.
That's what we're doing now, yeah. Because the government insures the system. Yeah, if you're an insurer and a lot of people die, you're going to pay, you know, because that's the business you were in. All right.
Mr. Seidman, thank you very much for being here. I really appreciate your frankness and the balance of your criticism. I really appreciate that. 2 questions.
No, one question.
Okay, I won't ask the one about the changes to mark-to-market. But
Mark-to-market, is that what you want to talk about?
no, actually, you mentioned Fannie and Freddie were in at the beginning of the problem. CNBC and David Faber earlier this year had a program in which Faber said basically that by the end of 2003, Fannie and Freddie were pretty much out of the subprime mortgage market. Is that true? By the end of 2003?
What did CNBC do? I didn't hear that.
CNBC had a program on earlier this year called House of Cards. The reporter
House of Cards,
was
yeah.
David Faber, and in it
Yeah.
they said, among other things, that, they pointed out Fannie and Freddie's involvement in the beginning, and then later on they said that by the end of 2003, Fannie and Freddie were pretty much out of the subprime market, and it was Wall Street that
Well,
really...
Fannie and Freddie were a terrible idea to begin with.
Oh, okay.
Yeah, I mean, they were a system by which a private sector company could borrow from the government or on the government's credit at low rates and then put the money out at market rates. So they could make a huge amount of money, and the bigger their inventory, the more money they made. So and Alan Greenspan was warning about that. I mean, if you put those incentives out there and you give an agency a governmental advantage, they'll put everybody else out of business, which is what they did. And they will manage their system so that the people who are running it will get the maximum bonuses. And then somewhere down the line is they'll try to get money into housing so people can have lower cost mortgages. It is a really bad system. And I know what to do about that. What you need is an agency that packages these things and reinsures them with a government agency. They don't buy anything, they don't have any incentive except to keep their insurance claims down. And so they will get the mortgages, put them in a package, guarantee them, and then reinsure with the FDIC or somebody so that people will buy them because they know they're insured. But there won't be any multi-million-dollar salaries because they aren't going to be making that kind of money. Anybody can make money if you borrow at government rates and lend at market rates. They aren't geniuses, but they were being paid $12 and $15 million a year, and mostly they were politicians who got out of the government, and the president said, well, you served me well. This is the cushiest job I've got around. I'll give it to you. I tried to get it, but Ford wouldn't do it, wouldn't he?
Mr. Seidman, how do you see the stress tests turning out? That the
How do I
banks
see what?
The stress test. What do you see the results of that as being?
I didn't, what is it?
Stress tests. Bank stress tests.
Well, I'm not sure I understand what the question is, so I can't give you a good answer, but...
They say that they're going to run a stress test to see how the banks will survive under worse conditions. It won't be a real...
Oh, stress test.
Stress.
Oh, I thought you kept saying mess. No, I know. Yeah, stress test. Well, the banks have stress tests all the time. The only thing that's new about this is that they gave set parameters for unemployment and growth rates and so forth, and then subjected all the banks to what would happen to them under these conditions. It's a good thing to do. It shouldn't have been made a high-profile thing. It certainly shouldn't be published bank by bank, because the ones that don't make it will go into a run, and they don't know what to do now, because they've said they're going to tell everybody, and now they know they can't. So stay with it. But I'll bet you a little bit that they are not going to say which banks did not pass that stress test. And if they do, it's going to cost us millions because you'll have to take them over. So they're not going to do that. So the stress tests are a good idea. Should have done it quietly and see what was going on. But they kind of made it like, this is the answer to where we're going. The Secretary of the Treasury, I don't know. I want to be very careful here. But he, along with everyone else in this administration at a high level, has never been in the private sector. There is not a private sector person in the whole group. And I think you need a private sector person or two. One, because they've done some managing. You don't really manage a government agency. They give you money and you spend it, but you can't manage it because you've got so many rules. We did it at the RTC because we got exempt from all the government rules, so we could run it like a private sector deal. And we did, and that's the reason it worked, and we got done in 5 years and said, we're done with our job, here's your money, and we left. So I think that's a real problem in this administration. Because if you never run anything and you set up a complicated system like this leveraged buyout of toxic assets. Man, you got to have an auditor at the arm of every guy in the system or they're going to steal you blind. And it takes a lot of time. I just wrote a piece for the Wall Street Journal. And they said, do you think the FDIC has enough people to do this? Write us an article about that. And I said, well, I don't know if there's enough people in the country to do this. No, it's a tremendous administrative job. All right, is that about enough? I think we should all adjourn. Is that all right? Thank you. Yeah.